How is everyone doing? Good. I'm sorry about the typing. I apologize there, Robert. Let me get focused here. We got 3 minutes. How's everyone doing? Guys enjoying the class? Learning a lot? We got a doozy today. It all comes together today, you know, into a big mishmash of strategies for you to sort of, you know, mix and mash together. Well, I'm for one excited. Oh, Ubuntu, yeah, good. Casey, have you Dockerized yourself yet? Please tell me that you're using Docker at this point, Casey. Sorry, I know there's a delay. Yeah, I mean, stop what you're doing and install Docker, and then you know, whatever platform, if you're on Windows or whatever, stop what you're doing and install Docker, and then, you know, Docker run Ubuntu latest, and then resume what you were doing. You will thank me later, in every way imaginable. It's you know, yeah, well, yeah, once you're absolutely, once you're in Ubuntu, right there on the command prompt, right? Docker run you know, node latest, right? Now you're programming in node. Docker run Python latest. Now you're programming in Python. Docker run, you know, Ubuntu, and now you're running Ubuntu in Ubuntu. You want to run Selenium, you want to run whatever it is, you just Docker run, you know. It's the last sort of it's the operating system for operating systems, you know. And then once you want to take that, like the step beyond, and you want to take that to the cloud, you go Kubernetes, because Kubernetes is the operating system for Docker. Because you can do Docker Compose, and Docker Compose is awesome, but just learn how to, yeah, Dockerizing. I Dockerize everything, because once you Dockerize everything, you specify, you know, I just need this layer for my operating system, and then I want you to layer on top of that this, you know, layer for my programming language, and then I want you to layer on top of that this layer for my, you know, database, and then on top of that I want you to layer what's it called, you know, my app. And then, you know, those 4 layers, they all live in RCS, and then if you want to reassemble them in a new order, it's trivial. It's like the most easiest thing you ever did. And then if you don't have a layer, it'll just go and fetch it. So if you don't have the Ubuntu base layer that you want to layer everything onto, if you don't have the, you know, the Windows base layer, if you don't have the you know, whatever operating system base layer, it'll just go and fetch it for you. It'll just go and fetch whatever things it are. So you can just deploy your entire application in terms of existing layers plus your layer, right? You say, I want Ubuntu with Mongo or MySQL on it, and it needs to have, you know, libdev and the compiler, and then it needs to, you know, do all these things, and these are all just layers. It just comes together. It's this beautiful layer cake. It'll change everything, I promise. All right, let's get started here. Yeah, like I said, we're gonna get started on time, and I'm a minute late. Yeah, it's Legos for computer systems. Okay, let's get started. Good afternoon. I am Sensei Kevlar. Welcome to the final lesson of the Way of the Dragon. Previously in the Way of the Dragon, we explored how we could get data out of the markets and analyze it in a programmatic way and generate signals with it that we could take to our social network. We talked about story crafting, we talked about message crafting, we talked about how to build a message, and then we finally talked about how to program charts. Today I really want to bring it all together for you into a complete picture. Remember that how this all started was with people on a bid-ask protocol. And if you watched my dojo lesson earlier and you went back to derivatives and the way these things work, you might realize that this is just an example of somebody just propping up a market. That's really all we're talking about. Now these markets, they don't have to have no value. They don't have to just be forks of some existing coin. They can provide value in and of themselves through their derivative value. It doesn't have to be that a token represents nothing, or a token represents what people think it's worth. It can be that a token can be redeemed for a security, an object, an asset. If you want to structure something that has utility, give it utility. I want to talk a little bit about examples of blockchains that have utility. The first blockchain that I want to talk about is the most famous one of them all, Bitcoin. Why does Bitcoin have utility? Well, let's go back to the foundation of it for a minute. Sorry, I'm just pulling up the Bitcoin white paper. Bitcoin has utility because Satoshi Nakamoto designed it to provide incentive. He designed it to provide incentive to those who added value to the network. What value did the network add? What value was needed for the network? Well, we needed to distribute the blockchain. Why did we need to distribute the blockchain? In order to prevent transactions from getting mixed up. How do we make that fair? Through proof of work. Then we can optimize. Optimization. 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 More optimizations. The idea was that we could do it all without trust. Now, if you want to build something else, let's look at what has more value than that. Ethereum. Why does Ethereum have more value, have the second largest market cap by far and away, mind you? By far and away, compared to, I don't know, Ripple or Bitcoin Cash or Litecoin? It's because of the ICO. That's not what I wanted. The initial coin offering changed the deal. Because what we're doing is we're creating markets on top of a blockchain that provide additional utility. These markets provide additional utility not through their speculation. And that's the critical game changer. Previously, the way that this worked was we would have Bitcoin doing its thing, And it's providing its incentive in a very fixed way. And that fixed way is very well understood. And it has the largest network in the world, largest distributed network, fastest hashing network in the world. As a result, it has the largest offering in the world, the largest coin market cap. That coin market cap, that market cap represents how much money all of this value is worth in the real world. That's what ultimately matters, that coin market cap. So in order to give yourself a fighting chance with a coin market cap, it takes more than speculation. It takes speculation that this offering is going to go somewhere long term. If you want to think long term, you need to think about how people are going to get their value long term. Satoshi thought it through. Satoshi thought through the way in which he can structure the blockchain to provide utility that was not previously existing, that would give incentive to people who provided that utility. Ethereum took it to a new level. Ethereum took it to a new level because what it did is it changed the way these whole things work. By creating businesses which operate themselves in their entirety on the blockchain, we gave rise to a new form of token. Rather than simply being a token of account on a network which provides utility, it becomes a token of account on a network, rather than provide a token of account for a network which provides a static, linearly increasing utility, or potentially, or basically unchanging utility. It's a well understood utility that varies. The amount of utility that it adds varies based upon the network. Either it's paying out more or it's paying out less to the miners because the difficulty has gone up or the difficulty has gone down. Either it's requiring more or it's requiring less of its users. Why? Because demand has gone up and therefore network fees have gone up. Therefore network fees have gone up, pushing the cost up, pushing the utility into those who really need it, who are willing to pay for it, pushing the value up long term. These things, which now has given me some ad, have the same potential. Except they have the same potential individually. Individually, they have the potential to do things like payout from Visa cards. They have the potential to, simply by holding these things, pay out. That's why it's called pay, is because they give you a chunk of the merchant fees from the credit card product that they're intending to launch. Same thing with Plexcoin. These have the potential for long-term value because it's going to pay out from the services that it will provide. Simply by holding the token, you might get more money. And that's what's causing the speculation, but it stops becoming speculation after a while. So let's look at a counterexample now. Here's an example of a market that failed to provide utility long term. Okay? All of this was driven off of speculation. Speculation, speculation. You can see the yearly pattern here. the yearly speculation pattern where we got to make our money and we drive these markets up, we even skip years sometimes. Here we skipped a year on the yearly cycle. But what's going on here? Is there a trend forming off that wick right there of the highs that we can achieve? Long term, these things will ultimately be speculated upon, and so long as you are speculating upon them, all you're ever going to see is this motion right here. The only way that something can have value long term is if it is giving itself value long term through the structuring of the offering, through the structuring of the product. So let's talk about a couple different ways that you can do this. One of the ways I've already mentioned is to have a token which pays out. How does the token pay out? From the business. What does the business do? Make it up. Whatever it is that you think there's demand for, make a product out of it. Have a product, sell your token around your product. This is ultimately how you drive value long term, because if that value is structured around that token, and that token is what is giving those owners that value, let's say that that value comes in the form of voting rights. Let's say that that value comes in the form of additional tokens. Let's say that that value comes in the form of investment opportunities. Let's say that that value comes in the form of the ability to pay cheaply, efficiently, zero transaction fees, quick, easy confirmations. Whatever value you're providing, that's ultimately what's going to drive your value long term. Simply sending the signals is not enough. Once you send the signals that this is going to occur, make sure that you have a plan for keeping it up here too. That comes in the form of utility. That comes in the form of demand long term for that utility. That comes in the form of a product that pays out. A product that pays people in its utility, in its, I'll find it, incentive. If people do not have an incentive to do something, they will not do it long term. You can absolutely get this, and then you'll get this. What you need to understand, and this is ultimately the critical part of all of these lessons, and if you miss this, you're going to miss the point. This is destructive behaviors. Coming all the way up and then going all the way back down. All this does is hurt people. This is not a healthy behavior for a market. It should not be coming down and crashing down lower before and creating larger bag holders than ever before. It should be marching steadily upward. Marching steadily upward, providing value long term. These are what we effectively call shitcoins. And there's a couple different reasons that things become shitcoins. One of the reasons that something becomes a shitcoin is it starts out with the wrong set of network parameters. The wrong set of network parameters is one that ensures that the increased supply will always outweigh the demand. Satoshi Nakamoto very carefully outlined a methodology for increasing the difficulty and decreasing the coin reward over time. He specified that this would happen at every 4 years the coin halving, that this would happen in approximately every 4 years, and the difficulty would adjust in order to ensure that it would. Here's the probability drop-offs right here. He figured out that by structuring his network in such a way that demand would always outweigh supply, we would always get additional value. Are these possible in other markets? Well, I'd say so. If you look at these types of patterns. Can we see it in the short term? Sure, if you look carefully. There's the pattern right there. Here's the problem. And here's the whole point of today's lesson. These are destructive behaviors. These destroy value long term. They hurt people. This is a healthy pattern right here. The slow, steady gain over time. This is the only healthy, sustainable pattern that you can expect to ever actually see work long term. Short term, this may seem like fun in games. Short term, this can absolutely produce opportunity. Short term, some of these markets are only good for that. Long term, these types of opportunities eventually turn around. Eventually, they don't look like this anymore if you do this enough times. If you do this enough times, eventually, this is what happens. They come down to a new low. They start to create new lows. And when they start to create new lows, they have problems creating new highs. And if they can't create new highs, ultimately, they don't have a future long term. And that's a problem. You want your markets to stay around. You want your markets to stay in the game. But these markets that you don't value correctly, that you don't provide the value to, that don't provide their own value, that people do not provide that they speculate on and they push and they pump around and they destroy them. Ultimately, this is a good strategy for getting a market to move. Absolutely. And that's what I've taught you. This is a good strategy to destroy value long term. Now, how do we combine the two? The answer is in the message crafting. The answer is not in, the quick, just tell everybody that it's going to go up forever. The answer is in the message crafting, in that if you tell them that it's going to go up, you also need to tell them it's going to go down. Ultimately, you really don't want them buying this because this is just going to be unsustainable long term. What you want them to do is be buying this. Because when they start buying this more and more and more, eventually it does turn around. Eventually we get rich on this. These are opportunities, but you have to measure them correctly. And if you don't measure them correctly, you can end up on the wrong side of this trade. If you don't have a plan for long term with these, for how you're going to create long-term value in these markets will bite you as soon as they make you rich. By creating markets which give value long-term, they pay out to their owners, they give access to their owners, they give voting rights to their owners, they give value to their owners in the form of incentive, in the form of trust, in a trustless network. Ultimately, you can create products, coming back to the derivatives, products which have value long term. The perfect example of the product that has long term is a derivative product that adds additional value. The perfect example of a derivative product that adds additional value is one that can be redeemed for its base product. The most obvious example in the world here is one that we use all the time. BTC, USDT, we say it all the time. The way Tether works is it's just a cryptocurrency contract that says you can redeem this for $1 because it's always going to be worth $1 because there's always going to be somebody who's willing to sell it at $1. A bot who's got a sell wall up at $1. What that means is that the value of a US dollar Tether is always $1, no matter what, until that changes. Well, what if the token had additional properties? What if you structure vehicles, products that you can sell that give additional value that are derived from an existing product like $1? This is how you can structure a value market long term. And you can do it trivially. They did it, Tether did it, simply by saying, well, we're going to create a cryptocurrency and then charge people, more than $1 for it, $1 plus fees. And then we'll eat the fees, and that's how we'll make all of our money. Anybody could prop up a network like that. And it can add value. It can add value in terms of a product that people will demand long term. People will demand this product long term because they need something to represent $1 on the blockchains. If you want to create a market, you want to work a market, you want to push a market around, think long term. Don't think about, how you can just do this and get in and get out, because you won't be able to. If you're in a low volume market, you have to think about how you can create volume in that market. It's not enough to just push the market around. You actually have to get buyers to come back in and believe that the market is going to go up long term. Well, if they believe that the market is going to go up long term, then it really does have the potential to go up long term. But then if it doesn't have that value long term to continue going up, eventually it's not going to stop going up. It doesn't have to be that way. It doesn't have to be the case that you destroy market potential in order to create market value. You can combine both messages. You can combine both stories and create genuine incentive to be in a network. Initially, we talked about how to program a chart on Monday. And I showed you how to work these order books in order to push these order books around. Well, that's fine for doing it short term. But how would you do it long term? How would you actually give a market value long term? It's the same thing. You just have to think about it on a longer time frame. And you have to bring in automation in order to craft the correct story. So now we're going to do all three at the same time. Number one, we're going to hook up to the API, and we're going to schedule our distribution and allocation according to our plan and what we want to see this market do long term. Number two, we're going to get other people to believe in that plan. We're going to have them come in here and share in the plan and get them to, storycraft around this idea that we can actually do this long term, that we can allocate long term and then distribute long term. Push the order books around long term. Automate, storybook, chart programming. You combine the three with a product that really does have the potential to pay out long term, and now you're creating your own opportunities like a dragon. And that is the way of the dragon. I hope this has been incredibly helpful for everyone in understanding the nature of opportunity generation with regards to creating markets, giving them value long term, crafting stories around them, automating the entire process so you can do it long term. Not just days, not just weeks, not just months, years. Move a market over years. Schedule the next year. Schedule 365 days in advance. And then after 180 days, schedule 365 days in advance of that. Having a plan and being disciplined to the plan never changes. What changes for the way of the dragon is how we execute the plan, how we go about our planning. It isn't just about following the signals. We are creating our opportunities to generate these signals long term. We are working our network. We are creating our opportunities through story crafting, through signal generation, through automation and automated analysis. And ultimately, this is where you want to go. You don't want to be a slave to somebody else's token, somebody else's vehicle, somebody else's network parameters, somebody else's way of doing things on their blockchain. You want to have your own blockchain. And then you want to do all of those things for your product. Create your own market, automate its opportunities, craft those signals, rally the troops, tell them the correct story, plan the trade, and trade the plan. And that is the way of the dragon. Thank you very much, everyone. I look forward to any group discussions that we have remaining around this. But I think that this will close out our lesson. There will not be a lesson on Friday except for me to say to you, thank you for attending. Thank you very much for listening about how to take your profession to the next logical step. I urge you to consider everything that I have taught you and revisit what I said in the very, very beginning of this, which is that ethics is about application as much as it is intent. Do both well, and you'll sleep fine at night. I look forward to working with you all.